Hello, Business 330 students. This is Professor Hassey. It's our week number 4 halfway point of our course update video. Today's date is Saturday, July 1st. Happy July 4th. And if for any of our Canadian citizens out there, happy Canada Day today, this holiday weekend. Hope you're all well. Our topic today is to wrap up a week number 4 topic of capital valuation, which includes bonds and stocks. We have an assignment number 3 due this Sunday, July 2nd. Extensions are available if you need some extra time. Also, we have a introduction video going to be posted Sunday, July 2nd on our course assessment case, the Road Kings case, which is due on July 30th. And again, you have about 3-4 weeks to do that, but I'm going to post it. We'll begin the discussion of that work in our week 5 lecture video, which will be posted Monday the 3rd. So 3 straight days of videos. I can't think of anything more exciting to spend a holiday weekend with Professor Hassey and his ugly mug talking to you about business finance. But that's the way it is, so here we go. First off, I want to apologize. I posted the incorrect assignment 3 earlier this week. I have corrected that file and posted it yesterday. And thank you to Stella, one of our students, for giving me a heads up on that. I don't know what I was thinking. But so please make sure if you've already posted assignment 3, some students have, that you have the correct version of it. And let me explain. I had these stock questions both in the bond and the stock parts in the original assignment, which is basically I doubled the same problem, which is not right. So I changed the bond questions to these 2 questions, and then the 3 stock questions in the multiple choice. Again, the stock portfolio is the same. You had to update that as of this past Friday. So again, part 1 has been corrected and changed, and that's the correct version. It's now posted in Blackboard. Please make sure you check your version, that you have 2 separate parts with 2 different sets of problems in your assignment 3. And I apologize for that. And I apologize to the students who've already posted and was not aware of this. So hopefully you can adjust that this weekend if you've not done so. So that's our assignment 3 due on Sunday, July 2nd. Another thing I wanted to talk about is some students were having difficulties with the assignment 2 multiple choice or questions on the future or time value of money. And I have posted in the assignment 2 file folder a spreadsheet solutions for those 4 questions on the calculations of the present value, the future value of money. So here's that file. So if you're having a difficult time understanding that, here's the answers to questions 1 through 4. The future value of $10,000 with simple interest, not compound interest, but simple interest, is $13,000. What is the present value of a trust fund if it promises to pay you 7 years from today, $50,000 with an annual rate of 10%? There's the calculation, 25,657.91. This was perhaps the most stressful one of the 3 problems. You're receiving cash flows of $1,000 today, $2,000 at the end of year 1, zero in year 2, 4,000 in year 3, 0 in year 4, and 6,000 at the end of year 5. What is the present value of these? Here's that calculation to show you that right here. And then question 4, if I borrowed $120,000 with monthly payments of $965.55, if I take that $965.55 and multiply it times 360 payments, and then subtract out the amount that I'm borrowing, that must be the interest of $227,598. In this problem, I was not looking for you to calculate all that, but just simply understanding the concept of a amortized loan with the monthly payments being the same, you can back into that interest rate number. So a couple helpful hints in a file for assignment 2. Now I want to go over a couple of things from this week's in-class review of our lecture video the other day and talking about the definition of stocks and bonds. Excuse me. From chapters 6 and 7. Remember, bonds is a debt instrument where a company promises to pay you a specific amount of interest over the life of the bond or the debt, and then at maturity, the principal will be paid off. For example, here's a $1,000 bond, and again, all bonds are in $1,000 allotments with a monthly yearly annual coupon payment of 7%. So if I take 7% of $1,000, that means every year the company issuing that bond and borrowing the money has to pay the lender, the bondholder, $70 a year and over the 10-year life. Then at the end of the 10 years, you get the $1,000 back. Now, one of the key things that happens in bonds, and also it shows us the relationship of interest to asset value, is what if I decide to sell the bond? Let's say after 2 years, I want to sell this bond, this 10-year bond, paying me $70 a year. I want to sell it at the end of 2 years. So you can go into the market and sell the bond, but interest changes. And let's say the current yield of this bond, even though the coupon is 7%, if this company would issue this debt today, 2 years later, they would have to pay a yield of 8%. In other words, the cost of money has increased. So who's ever going to buy this bond from this individual would have to buy a 7% bond in an 8% market. How much would they have to pay? Well, it's very easy. Formula, function, present value. So now the interest rate in the yield is 8%. The number of periods remaining, remember 2 years have gone by on a 10-year bond, so 8 years remain. The annual interest payment is $70 on this bond, and the future value, what you get at the maturity, is $1,000. This bond would be currently priced at $942.53. That means the bond is at a discount. In other words, interest rates in the market have gone up higher than the coupon rate. Thus, the bond's value has decreased in value. So who's ever going to buy this bond from this individual is going to pay $942.53. Not bad. In return, they get the $1,000 back in 8 years and $70 a year in interest. Why are they paying a discount? Because they're giving up the ability to get $80 a year in interest by buying the 7% bond in an 8% market. That's buying at a discount. The same thing holds true with what happens if the current yield is now 6% in the market. Same formula, function, present value. The interest rate now, the current yield is 6%. Still 8 years remain. Still the payment is still $70. And still the future value is $1,000. Notice now this bond has a value of $1,062.10. That is called selling it at a premium over the original par value of $1,000. Why? You're selling a 7% bond in a 6% market. So the person now who's buying this bond is going to pay $1,062.10 to get $1,000 back in 8 years plus $70 a year in payments, interest, when in the current market, they would only get $60 a year. So they're paying more or premium to get those additional $10 a year interest payments. Asset values increase when money is cheap. Asset values decrease when money is expensive. In other words, interest rates go down, asset values go up. Interest rates go up, like today, asset values go down. A cardinal discipline or tool in finance, the relationship of interest to fixed debt or fixed instruments. And this is something we'll be seeing a lot of over the remaining half of our class, a key point of bonds. Secondly, there's stocks, where bonds is lending money or borrowing money at a specific credit rating and paying a specific amount of interest over a period of time. Equity or stock is buying equity in the market. The investor who's buying the stock is hoping, expecting to get a certain return off their investment from the company. If the company does not do well, they won't get much of a return. And what does it mean for return in stock or equity? It's broken down into two areas. Dividend yield, the relationship of the dividend payment every year on a stock by the stock price that you purchased at. For example, if I get a dividend of $4 a year from the company and the stock price was purchased at $20, that's a dividend yield of 20%. Now, let's say the stock price goes up to $22 a share and I sell it, meaning I'll have a capital gain of $2 or a 10% capital gain. Thus, my total return on the stock would be the 20% dividend yield and the 10% capital gain, or 30% return on investment. That's also calculated by taking the dividend of $4, the gain of $2, that's $6, and $6 is what percent of the original stock price? 30%. So when you have a 401k or you invest in Robinhood or buy a mutual fund or invest in equity markets, your return can be in two forms. Dividends that you're being paid as a share of the profits of that company. And two, if you decide to sell it, the capital gain or the profit you make between what you paid for that equity and what do you sell it for. And that's what drives stock prices. Investors want the stock to keep going up so they can obtain the large capital gain. Now, naturally, for some investors, that large capital gain will necessitate in a big tax bill, but that's for another time and another class later. So a key thing in bonds is interest. The interest you receive off the amount that you're lending. In stock, it's dividends and stock price gain is where you receive your big investment return. Also in stock, there's a lot of calculations to determine the value of stock over time. Some of it's called the constant growth model, where you take the current dividend and divide it into the expected growth rate of the stock and the expected return that the investors want. One of the key areas of this is the capital asset pricing model, what the investors expect to return over time. So one of the key areas of stock is why does everybody buy stock? Because you want the price, you anticipate the price to grow into the future. Well, there's many ways of determining what you can expect from that stock growth in the future if you know what the company is doing. That's why all companies file 12-month projections every quarter to let the market know what they anticipate doing. So here's an example. Let's say this company has plans on paying dividend in the next year of 75 cents a share total. The expected return off investors that they expect to return off this stock is 9%. And the company expects to grow at a 7% growth rate in the next 12 months. And all companies have to show this. So what is the anticipated price of this stock? It's sometimes called the intrinsic value. Well, the price is taking the 75 cents a share and dividing it by the difference between the expected return and the expected growth, or 2%. So if I take 75 cents and divide it by 2%, I get $37.50. That's what is called the intrinsic value. That doesn't mean that's what the stock is trading in the New York Stock Exchange. It means based on the anticipated return over the next 12 months, this stock should be at $37.50 today. Now, if I go to the actual stock market and see that the stock is currently trading at $40 a share in the market, that means the stock is overvalued, meaning I wouldn't buy it at $40. I only think it's only going to be at $37.50 in the next year. That means it's overvalued. So if I have yet to purchase a stock, stay away from it. If the stock is currently trading in the market at $30 a share, then I would buy it. It's considered undervalued. In other words, the stock is cheap. It's selling in the market at $30 where I think it has a value to go as high as $37.50. It's a buy. This is what drives all the markets. This is what drives your stock portfolio that you just recently valued on Friday, June 30th. If investors think the stock price is undervalued, they will buy it and the stock will bid up in price. If investors think the stock is overvalued, the stock will begin to sell off and drop down to that intrinsic or determined stock value of today. These are key ways of determining the value of equity investments. We'll talk more about that as we go forward in our class. And this is all called the cost of capital. Our subject this week is capital valuation. What does it cost us to get the money to invest in assets? Two ways: the cost of debt, which is interest rate, and the cost of equity, which is what the investors expect to get as a return from the stock. This is important, and we'll talk much more about this in our week 5 and week 6 when we look into capital budgeting. Because remember, we're going to invest in an asset. What does it cost us to get that asset versus what we expect of a return off that asset? And that's what the market is all about. And that's what mainly all CFOs do in their jobs. They determine or gauge the company in the market and try best to manage their capital outlays or budget or asset buys to meet the guidelines that the investors determine as their proper returns. Returns on debt are interest, returns on stock or equity are investor expected return. Those are the two key points coming out of this week's study: stocks and bonds. And that's what we're asking those questions in assignment number 3 this week. Okay, so that wraps up our week 4 update video. You have assignment 3. Remember, as I said earlier, there's a newer version that was posted on Friday. Here is that version. Also, you need to update in a separate spreadsheet file your portfolio. Here's a sample of what that portfolio file should look like that you will post this Sunday. So assignment 3 this week, I will have a video posted on Sunday evening, which will explain your course assessment case, which will be posted this week. And on Monday, we'll have a video introducing capital budgeting, capital investments for week number 5. We're at the halfway point now. Make sure you understand and know where you stand as far as grades are concerned, your cumulative average in the course up to this point. If you have any questions or concerns about that, please let me know. I'm not traveling this weekend. I'm home with my dopey relatives. So if anybody needs anything, I'm an email, a text away. Have a great holiday weekend, everybody. We'll see you with 2 more videos this weekend. Until then, adios.